So picture this. An Ohio man is sitting there signing the papers for a 30-year fixed mortgage at 6.6%, and he stops and asks his loan officer, hey, who actually decides 6.6%? And his loan officer just kind of gives him this corporate smile and goes, well, that's just where rates are right now. But come on, that is not an answer. That's just a shrug.
Here is the actual answer. That mortgage rate, it absolutely wasn't picked by his bank. And actually, it wasn't even picked by the Federal Reserve. It was set by a massive, mind-bogglingly huge $145 trillion market. To put that into perspective, this market is bigger than every single stock market on Earth combined. It's the invisible force that dictates your rent, your car loan, and whether your supposedly safe retirement funds just quietly lose 17% in a single year.
Welcome to This Explainer. Today, we're diving into the invisible machine that prices our entire lives. Look, I know this is a market that has all the personality of a tax form, but honestly, it has twice the body count. By the time we wrap this up, you're going to understand exactly how this invisible machine works, and most importantly, how you can protect yourself.
Okay, we have to keep this stupidly simple right out of the gate because finance guys love to overcomplicate things. A bond is just an IOU. That is literally it. A government or a big company needs money, so they borrow it from everyday investors like you and me. In exchange for your cash today, they promise to pay you a fixed amount of interest every year, they call that a coupon, and then they give your original money back on a specific date, which is called maturity. When the US government does this, they're selling treasuries. When companies with, let's say, slightly shaky finances do it, they sell junk bonds. Although Wall Street brilliantly rebranded those as high yield just to make them look better in a glossy brochure.
All right, let's get into Section 1, the golden rule of bonds, the seesaw effect.
The best way to understand this is to think about a used smartphone. Let's say you buy a brand new $1,000 bond that pays 2% interest, so you get $20 a year. It's boring, but hey, it's fine. But fast forward a year, interest rates go up, and brand new bonds from that exact same borrower are now paying 5%, or $50 a year. So, who is going to buy your old bond? Nobody. I mean, why on earth would they take your $20 a year when the new guy pays $50? Your bond didn't change at all, but it is now the financial equivalent of a used iPhone 11. It works perfectly fine, but you're going to have to sell it at a massive discount to get anybody to take it off your hands.
So here is the absolute crucial point. It's this seesaw rule. When interest rates go up, existing bond prices go down. Honestly, you should probably tattoo this somewhere because every single financial disaster we're about to cover is just this exact rule operating on a larger and larger scale.
Moving on to Section 2, the economy's check engine light, the 10-year Treasury. If aliens landed on Earth tomorrow and asked you for the one single number that controls the entire human economy, you wouldn't show them the stock market. No way. You would show them the 10-year U.S. Treasury yield. Right now, it's hovering right around 4.5%.
And this number brilliantly illustrates exactly why your mortgage is what it is. A bank looks at that 10-year Treasury and thinks, okay, I can lend to the U.S. government completely risk-free for 4.5%. Why would I lend to a random human being for 30 years at that exact same price? Spoiler alert, they wouldn't. They add a premium, roughly 2%, just because, well, you're a normal human who might lose their job. And boom, that gives you a 6.5% mortgage. This is exactly why the entire 2021 housing market basically froze mid-bite when the 10-year yield suddenly ripped higher. The bank didn't do that to you. The bond market did.
Oh, and it actually gets better. This market predicts recessions with terrifying accuracy. See, normally, lending your money for 10 years pays you more than lending it for 2. That makes sense, right? More time, more risk, more reward. But when that flips and short-term bonds start paying more than long-term ones, we get what's called an inverted yield curve. Since 1955, this weird little signal has correctly called every single U.S. recession. It's going 9 for 9 with just one single false alarm back in the 1960s. I mean, your daily horoscope really wishes it had that kind of hit right.
This kind of predictive, invisible power is exactly why the political strategist James Carville said this famous quote back in the 1990s. He said he used to want to be reincarnated as the president or the pope, but now he'd come back as the bond market, because as he put it, you can intimidate everybody. He really wasn't joking.
Which brings us to Section 3, when safe investments crash, the 2022 disaster.
Look, for decades, we've all been told that stocks are the risky part of your portfolio and bonds are your safe, reliable seatbelt. But nobody tells you about duration. Duration is your hidden risk label. It literally measures how much your bond's price is going to drop for every 1-point rise in interest rates. In 2022, the Fed jacked up rates by over 4 points to fight inflation, and because of that seesaw rule we talked about earlier, long-dated zero-coupon treasuries lost 39.2% of their value. That was the worst year for those bonds since 1754. Think about that for a second. We hadn't even invented America yet, and bonds had never had a year quite that bad.
Let's look at the dominoes and see how this actually builds at scale. Domino 1, Silicon Valley Bank. They took in a massive amount of deposits and parked $91 billion in supposed safe, long-term bonds. But when rates spiked, the used iPhone problem kicked in hard. They suffered a silent $15 billion loss. When their depositors realized this and totally panicked, the 16th largest bank in America was literally killed and seized by regulators in about 48 hours.
Domino 2, the United Kingdom. So in September 2022, Prime Minister Liz Truss announced £45 billion in unfunded tax cuts. The bond market looked at the math on that and essentially said, yeah, absolutely not. Yields spiked massively, which detonated a complete doom loop inside British pension funds. It got so incredibly bad that Truss was forced to resign after just 45 days in office. She was literally outlasted by a live stream of a head of iceberg lettuce. The bond market essentially fired a G7 world leader.
Domino 3, Austria. During this really bizarre moment in 2020, there was $18 trillion of global debt floating around with negative yields. So Austria decided to issue a 100-year bond paying under 1%, and investors actually bought it. But then, of course, rates normalized. That rock-solid, century-long government bond ended up losing 75% of its value. It basically performed exactly like a meme stock, just without any of the fun Reddit memes.
Okay, Section 4. The government's maxed credit card, the $39 trillion TAD.
Here is a truly staggering reality. The United States now spends over $1 trillion a year just on interest. That is simply the minimum payment on the national credit card. We are now spending more money servicing our old debt than we spent on the most expensive military in all of human history. Interest has literally become the second biggest line item in the entire federal budget, sitting only behind Social Security.
And there are very real-world consequences to walking around with a maxed-out credit card. With debt hitting 100% of GDP, Moody's actually downgraded the U.S. credit rating in May 2025. Foreign demand for our debt has softened a lot, and the market is starting to really throw its weight around. Just look at how this played out recently. In April 2025, right after a big tariff announcement, investors aggressively dumped treasuries. Yields spiked, and the administration actually paused the tariffs in under a week because the market got queasy. Think about that. The most powerful government in the world had to back down to bond traders.
Finally, Section 5. How to protect your money, the actionable playbook.
First things first, you need to compare your options. The national average savings account pays a completely pathetic 0.5%. Meanwhile, 3-month T-bills and money market funds are paying somewhere closer to 4%. Guys, that is the exact same money with the exact same level of safety, but it gives you 8 times the interest. Plus, T-bills are generally exempt from state income tax. Your bank is really counting on you not knowing this.
Second, you absolutely have to know the difference between an individual bond and a bond fund. This is huge. If you buy an individual treasury and hold it all the way to maturity, you get your full principal back, guaranteed. A bond fund, on the other hand, never matures. It's just a basket of bonds that gets repriced every single day. So if rates rise, that fund is going to show a minus sign on your statement. That right there is exactly what completely surprised millions of retirees back in 2022.
So just to recap, here are your 5 essential rules. Number 1, ditch those regular savings accounts. Number 2, know exactly what kind of bond vehicle you own. Number 3, check your duration risk so you actually know how a rate hike is going to impact you. Number 4, use I-bonds or TIPS for inflation protection. Remember, I-bonds were paying an absolutely incredible 9.62% back in 2022 because they're basically government-sold inflation insurance. And finally, number 5, keep an eye on that 10-year Treasury yield. It really is the economy's check engine light.
The truth is, you've actually been participating in this invisible machine your entire adult life. Every mortgage, every car loan, every single dollar sitting in your 401k. You were always in the game. You just never had the rule book. Well, the bond market is going to keep pricing your life either way. The only question is, now that you finally understand the rules, will you be able to read the price tag? Thanks so much for joining me on this explainer. Stay curious, and I'll see you on the next one.